Hey guys, it's Chad Larson with MLD Wealth of Money Matters, and this is July's episode. This one's going to be titled Price Action is Not the Thesis. Boy, I got a lot to get through, but here's a question I want you to sit with before we get into any of the numbers. So first off, when markets cool off, when the thing you own goes down for a few weeks or a few months, what's the first thing that happens in your head? And be honest, for most of us, the first instinct isn't let me re-examine the cash flows of the business, let me re-look at the balance sheet and their long-term sustainability. It's maybe I was wrong. The price moved. So maybe the thesis is broken and I have to revisit what I'm doing. I want to build this whole episode around why that instinct is almost always backwards. Because here's the uncomfortable truth. Most of the time, when people abandon a good thesis, the thesis didn't change, the price changed. And the price dragged their conviction around by the collar. So we're going to talk about the difference between price action and an investable thesis. We're going to get into the wiring of your brain that makes you confuse the two. I'm going to show you what the central banks of the world are quietly doing with gold versus what the printing presses are doing with money. We're going to talk about how much energy this planet actually burns every single day and what that means for the next 25 years. And we'll talk about why things people treat as side dishes, international equities, infrastructure, belong right in the middle of your plate. I've also got a thank you to start with and a pretty funny story about the state I showed up in a recent podcast. So, let's get into it. So first off, the thank you, and I really don't want to rush past it. A few weeks ago, I was at the Liberty Grand Center in Toronto at the WP Wealth Professional Annual Awards, and MLD Wealth Management Group was named Advisory Team of the Year in 2026. And I want to be really clear about what this award is and it isn't. It isn't just a trophy for me. It's a recognition of a team. Curtis, Shannon, Mayhul, Gurman, Lauren, Melissa, Andres, Matt, and Paula, and every person who picks up the phone when a client is anxious and does the unglamorous work of getting it right. And it's a recognition of you, my clients and families who trusted us with their life's work. So thank you, and I mean that. So that's the thank you. But before I get into the markets, I owe you a funny story. And I'm telling you this partly because it's funny and partly because it's the most human I've been in front of a microphone in a while. A little while back, I got invited onto Amber Kanwar's podcast, In the Money. It's one of the top podcasts in the country. And if you don't know the show, Amber has had some serious heavy hitters in the guest chair. Mark Carney, David Rosenberg, illustrious company. So when the invitation came, I'll be honest with you, I felt it. I walked in and I took that seat proudly and committed to being on the show. Because somewhere along the way, you earn the quiet confidence that you've got something to say and that people actually listen. It's a real moment of validation in the business, and I don't take it lightly. Here I go, 90 minutes just chopping it up about the markets. On the back of the SpaceX IPO, I was ready. And I killed it. I want to be clear about that. The audio, fantastic. The video, not so much. I've been told my whole life I've got a voice for radio. Well, this one confirmed it. I also have a face for radio. If you want to laugh today, go search the episode on YouTube and you'll see what I mean. So here's the embarrassing part. I'm telling you this because I'm human and I'd rather you hear it from me. I showed up to that podcast ill prepared. And by ill prepared, I mean ill. Listen, it started with a monumental Saturday night. My wife and I had great friends in from Calgary to come visit us in Toronto, to see a concert later in the week. So naturally, we gave Saturday everything it deserved, which required a necessary Sunday brunch just to level set the damage I had done to myself, which spilled into an absolutely incredible Blue Jays game, which led to a long dinner, which led to a quick nightcap. And let me tell you, that nightcap did not stay quick. Toronto's a very big city, but it gets very small in certain pockets, and we kept bumping into more people that we knew. I woke up Monday morning in a complete haze and marched myself over to the podcast looking like I had been stung by a swarm of bees and I had slept in the ditch. But we course correct and we learn, which funny enough is the whole theme of today's show. Nobody is immune to a rough setup. What matters is what you do next. So let that be our bridge into the markets. So the setup here is that the markets are cooling. And let me ground this in what is actually in front of us. It's the end of June 2026. It's actually June 30. It's my son's birthday today. And we've had a genuine geopolitical scare for the last number of months. The Strait of Hormuz, 4 months of disruption, fragile peace, a weekend of strikes, and now talks in Doha. What did oil do? It spiked on fear and then it round tripped the entire war premium. WTI is back around $70, Brent near 74, both down more than 25% on the month. The whole thing up and all the way back down in a matter of weeks. Gold is down about 10% this month, on track for one of its worst quarters on record. Copper's off 6. And every one of those moves is happening during a live conflict in the single most important energy choke point on the planet, which is the opposite what the textbook tells you should happen. So what's going on? It isn't the Strait, it's the Fed. Inflation is sticky. Core inflation is running in the mid threes, the hottest in a couple of years. And the market has flipped from pricing rate hikes, not cuts. Rising real rates and a firm dollar are pulling the safe haven assets down. That is a monetary repricing wearing a geopolitical costume. And here's where behavior walks in the door. When gold's down 10% in a month, the calls don't start with, talk me through real interest rates. They start with, is the gold thesis broken? Should we be selling? We still have profits. When copper rolls over, is electrification over? The price moved, so people reach for the thesis, and it feels like rigor, but most of the time it isn't rigor. It's the price action doing most of the thinking for you. So in our next segment, I'm going to talk two clocks, price action versus thesis. So let me draw a very clean line because this is the whole game. There are two completely different clocks running on every investment you own. The short-term clock is price action. It's sentiment, positioning, flows, fear, greed, who's offside this week, what the machines did at 9:31 this morning. Over days and weeks, that clock dominates, and it is almost pure emotion and mechanics. It tells you almost nothing about whether you are right. The long-term clock is the investable thesis, supply and demand, economic cycles, replacement costs, scarcity, who actually needs this asset, and whether they can get it anywhere else. Over years, that clock is the only one that matters, and it grinds slowly underneath all the noise, and it wins. So here's the analogy I keep coming back to. The short-term clock is the chop on the surface of the ocean. White caps spray, the boat heaving around. The long-term clock is the tide. And the expensive, universal, deeply human mistake is reading the chop and thinking it's telling you something about the tide. It is not. A 10% drawdown in gold this quarter tells you what real rates did this quarter. It tells you nothing about whether the central banks of the world keep buying gold for the next decade. The thesis is intact. The price is just having a quarter. When you anchor on price action, you let the most emotional, least informative signal override the most durable, most informative one. You navigate by the chop instead of the tide, and the boat goes in circles. Segment 3 is the wiring and the hallucination. And look, this is not a character flaw, it's human wiring. We anchor, we see a number, the high watermark, what we paid, last month's price. We glue our sense of value to it. So when the assets trade below that anchor, it doesn't feel like a cheaper version of something that we wanted. It feels like a loss, like a verdict, like the market knows something we don't. And here's the part I really need you to hear, because it's the most dangerous version of this. After a long bull market, after years of things mostly going up, a kind of collective hallucination sets in. People start to believe deep down that markets go in one direction, and if they stop, that you have to leave, that every dip gets bought, that every correction is a gift, and that the line goes up to the right forever. And for a while, that belief becomes self fulfilling. Everyone extrapolates the same recent past. Everyone crowds into the same winners, everyone positions the same way, and the hallucination becomes real because everyone's acting on it. Until it isn't, until something cools. And all of those people who were certain markets only go right discover they all believe the same thing. And they all wanted out of the door at the same time. The longer the bull market, the more entrenched the hallucination and the more violent the moment it breaks. Listen, this is not pessimism. That's just cycles. The complacency is the risk, and the cure for it isn't prediction. Nobody rings the bell. The cure is behavior. It's having decided in advance what you own and why. And so that when price action shows up trying to renegotiate your conviction, you've already got the answer written down. So behavior management is the job. This is why I'll say something that sounds strange coming from a portfolio manager. The security selection is maybe a third of the value we add. The other two-thirds is keeping you in your seat. It's making sure you don't sell the right asset for the wrong reason. It's making sure that when fear is loudest, which is exactly when prices are the lowest, you're not handing your long-term thesis to your short-term nervous system. And it's the mirror image at the top, making sure when greed is loudest, when everyone's a genius and the hallucination is at full volume, you're trimming, rebalancing, taking some chips off the table. That euphoria says that you should be shoving back in. Nobody brags about the trade they didn't panic out of. There's no cocktail party story in it, but over a full cycle, it's worth more than any single call I'll ever make. The biggest returns in a portfolio are usually the losses you didn't take because you understood the difference between a thesis breaking and a price wobbling. So when markets correct, and they will again and again, the discipline is simple to say and hard to do. Go back to the thesis. Has supply demand changed? Has the replacement cost changed? Has scarcity changed? Has cash flow changed? If the answer is no, then what you're looking at is a sale, not a warning. So now let me show you two theses where the prices are wobbling and the fundamentals have been doing the opposite of breaking. So we're going to talk about the gold, the presses versus the periodic table. I want to start with gold because the price action right now is screaming broken. Gold's down 30% this year from peak. It's still up 20% from this time last year. And the thesis is quietly saying, here's what the central banks of the world are actually doing. Not saying, doing with real money. For 4 years running, they've bought more than 1,000 tons of gold a year. 2022 over 1,000, 2024 over 1,000, 2025 north of 800. They started this year buying another 200 plus tons in the first quarter alone. To put that into context, for most of the decade before this, central banks bought roughly at half the pace. So we're running at double the old normal, and we've been doing it for years. There's a really interesting chart right now that shows, pre-movement in gold prices, what percentage. And I gave this example as I have a safe at home that collects, rarities and oddities and things in travel. I always have, some U.S. cash, and I have some euros, and I have some British pounds, and then I have a smattering of weird currencies that I didn't spend while I was on holidays. But if I looked at that as the Larson Foreign Reserve, there's a certain amount of, and precious metals. I've got silver, I've got gold, I've got platinum, I've got coins. You just collect these things. It's my reserve. And if you measure prior to gold price action of what percentage would a central bank's reserves be in physical, keeping price action flat, central banks own less gold per foreign reserves than they did prior to this massive influx of buying and price action. And the reason being is because M2, money supply, is top right. So I want to step back and look at the whole pile. Central banks collectively hold something like 36,000 tons of gold, roughly a sixth of all the gold ever pulled out of the ground in human history. And in their own surveys, nearly 9 in 10 of them say they expect official gold reserves to keep rising. A record share say themselves plan to add. And about three-quarters of them say they expect to hold fewer US dollars 5 years from now. Why the shift? One date in 2022, when roughly $300 billion of one country's central bank reserves got frozen overnight, every reserve manager on earth learned the same lesson. In the same week, dollars held abroad are only as safe as your political relationship with the country that runs the plumbing. Gold in your own vault answers to no one. It cannot be frozen. It cannot be sanctioned. And this is the key part. It can't be printed. So here's the pairing I want to leave you with. And I alluded to that in my hand waving of a chart. On one side, the printing press, USM2, that's money supply, the broad money supply, is somewhere around $23 trillion and has been growing on the order of 4 to 6% a year over time. Roughly 30 cents of every dollar in existence was created since the start of 2020. The Fed is back doing quantitative easing. That's the supply of money. On the other side, the periodic table, the total above ground stock of gold grows by maybe 1.5% per year. That's all the mining on Earth running flat out can add. You cannot will it into existence. You cannot 3D print it. You cannot vote it into existence. You dig or you don't have it. One asset's supply is set by a committee and a keyboard, and the other is set by geology. Over a long enough horizon, which one would you rather be holding when there's more and more and more and more currency chasing it? Here's a thought experiment, and it's only a thought experiment, not a price target. If you ever tried to back the entire US money supply with gold, the US actually owns. The math implies gold price somewhere in the tens of thousands of dollars an ounce. Throw in the federal debt on top, and it's multiples of that. I am not predicting those numbers. I'm using them to show you how small the gold stock is next to this mountain of paper backed by promises. And that's the thesis. A 10% month doesn't touch it. The segment 6, energy and how much the world actually drinks. It's a good example. So now, I want to start with a number that generally stops people. Every single day, the world consumes about 100 to 105 million barrels of oil. Not a year, a day. Picture that for a second. 100 million barrels every 24 hours, refilled every 24 hours. And oil's just the part you can see. If you take all the energy humanity uses, oil, gas, coal, nuclear, hydro, wind, solar, everything, and you translate it into barrels of oil equivalent, you can compare apples to apples. You land in the neighborhood of 300 million barrels of oil equivalent a day. That is the metabolic rate of human civilization. That's how many calories you burn just being alive. So that's what it takes to keep the lights on, the planes up, the steel hot, and now the data center's humming. So here's the thesis part. The crowd loves to talk about peak demand like it's next Tuesday. The actual forecasts for people whose job is to model this, even the most cautious of them, don't have oil demand falling for years. And the big producer outlook just published this month has the world needing more. Global energy demand up better than 20% by 2050. Oil demand climbing towards 124 million barrels per day. Oil and gas together holding more than half of the entire energy mix all the way out to mid-century. And To meet the oil demand, is the estimate is something like $18 trillion of investment needed between now and 2050. Call it $700 billion a year. You can see why I'm bullish oil field services. And where's the growth coming from? Not just the West. India alone is expected to add something like 8 million barrels a day of demand. The global car fleet goes from about 1.7 billion vehicles to nearly 3 billion vehicles by 2050. And yes, a lot of those are EVs. But even then, gasoline and diesel engines are still projected to be something like 70% of that fleet in 2050. Add the AI build out on top, every hyperscale data center is underneath all that software, an enormous draw to the grid, and increasingly that grid leans on natural gas. So sit with the picture. Demand structurally up for decades. Supply requires trillions in investment just to stand still in a world where capital has been fleeing this sector for years. Right now, a geopolitical scare took 11 million barrels a day of Middle East production briefly offline and pushed developed world inventories towards the lowest level since 2003. About 50 days of supply is all that's laying around in barrels. That's a thin cushion. That's the thesis. And the month to month price of crude bouncing around with the headlines tells you exactly nothing about it. So, the next segment is, I call this the plate, main course, not the appetizer. So let me pull gold and energy and the whole behavioral lens together because it changes how you build the plate. For years, the playbook treated certain things like a garnish. International equities, a little sprinkle, a 5% satellite, an appetizer you order to be polite, infrastructure, real assets, a niche alternative, a side dish for the part of your portfolio you don't really think about. I want to flip that and flip it hard. In this regime, international equities and infrastructure aren't the appetizer. They're the main course and they're the ballast. And here's the behavioral reason, and it ties back to the hallucination. After a long bull run, the crowd is most concentrated in exactly the assets that have already worked. And right now, that's very narrow, very expensive, very domestic, and very AI flavored slice of the market. When everyone is certain about a same handful of names, that's not diversification. That's a single bet wearing a costume. International equities are how you own growth and value the crowd has forgotten at prices the crowd isn't paying, which is the entire point of buying what's out of favor instead of what's adored. And infrastructure, it's your ballast, toll roads, transmission lines, pipelines, ports, contracted power, heavy assets with contracted cash flows that you cannot reproduce without enormous capital and a decade of permitting. When the price action storm hits, ballast is what keeps the boat from rolling. It's the part of the portfolio that pays you to wait, that re-rates with replacement cost, and doesn't need sentiment's permission to deliver a coupon. In a world of sticky inflation and higher for longer rates, contracted real asset cash flow isn't a defensive afterthought. It's the most thesis driven thing you can own. And this is exactly what our Halo framework is built around: heavy assets, low obsolescence, high replacement costs, scarcity value. And notice, none of those four things is decided by what gold did this month or what copper did this week. They're decided by the long term clock, which is precisely why they belong in the center of the plate, not the edge. So, where we stand in conviction. So, let me tell you exactly where this team stands as we close out the month, because I don't want any ambiguity about it. There is a cooling tape. Gold's down, copper's down, crude just round tripped an entire war, and the crowd is busy asking whether the thesis is broken. We've done the opposite this month. We have grown more convicted, not less. We are holding our alpha. We are initiating the core positions, the conviction book, and we're actively building setups positioned for a violent move to the upside in our core thesis when this repricing exhausts itself. And that's the whole point of everything we've covered today: the fear and greed, the chop, the hallucination. What creates the entry? When supply is structurally tight, demand is structurally rising, and the only thing pushing the price down is short-term positioning and a hawkish rate scare, that's not a reason to leave. That's a coiled spring. We'd rather be early and patient on the right side of the long-term clock than fashionably late on the wrong side of it. We're not predicting the day, and nobody can, but we are positioned deliberately with conviction for the snapback, and we're getting paid to wait by the ballast while we do. So here's where I'm going to leave you. When the market cools, and we're in one of those moments right now, your instinct is going to be always to question the thesis, and that's okay. That instinct is normal, it's very human, but recognize for what it is: short term price action, fear and greed, reaching up and trying to overwrite the long term economics. It's the chop trying to convince you it's the tide. The cycles rule, supply and demand rules, replacement cost and scarcity rule. Central banks are still buying the thing you can't print. The world still drinks 100 million barrels a day and is going to want more. And the job, your job, and our job alongside you, is to manage the behavior in between so the noise never talks you out of the signal. So don't let price action think for you. Go back to the thesis. Build the plate so the main course and the ballast carry you through the moments when everyone is busy hallucinating. Thank you again for the recognition this year. It belongs to this whole team and to you as my client. I'm Chad Larson. This has been MLD Money Matters, and we'll see you next time.